Good morning. As Justin just outlined, I'm Anthony Jones. I head up the research operation at Thinkbox in the UK. But hopefully, by the end of this presentation, you'll realise that this isn't a piece of research that's just applicable to the UK, that it has some relevance for this market. I've got not one, but two QR codes at the end. So you can click on those to get access to all sorts of goodies if you want. So don't feel the need to take lots of notes. I've got a 133-page book lying around that has everything in every combination you can ever imagine. So what is profitability 2? That's not working from there. What is profitability 2? It's version 2 of profitability. A lot of money spent with our marketing team inventing that name. Basically, we did a study in 2017 which was tasked Can you hear me now? No? I'll stay here. Don't worry. It will work. 2017, we did a study which was tasked with identifying, does advertising pay back? You know, can people make money? And in money, this terms we mean profit. Is advertising delivering a profit? The good news is, in 2017, we conclusively proved that there was a business case for advertising. As most of you know, there's been quite a lot of stuff that's happened since 2017. Had a pandemic, there's whole sorts of distribution channels, thumbs up from the back that I can now move. There's lots of privacy and data issues that we've had to worry about. The rise of the streamers we've all spoken about. Very specific to the UK, this thing called Brexit, where we exited from Europe. That went very well. And we had a fundamental structural shift in the way that advertising works in the UK. What do I mean by that? And okay, this next chart comes with a health warning. This is what's happened to the UK advertising market since 2010, but specifically look at 2017. The blue line is investment in social, native, and search. The red line is what's happened to established media channels. Okay, and this is current prices. So actually, there's been a decline in investment if you take into account media inflation and inflation. The money has flown away from traditional media channels into search, social, and native internet. So such to the situation, this in the UK is where the money is currently being split. So when you're looking at the market at this kind of data, the perception from a lot of people is something's dramatically happened. The money is flowing into search and social and away from other channels. Do those other channels therefore still work for advertisers? Why should I be investing them when the money is flowing away to search and social? There's lots of good reasons that we can explain it. Won't go into today. Part of the problem is they've decided to include a lot of SMEs. Really small businesses are now who are spending sort of a few $1,000s. It's been included in the search data. So it's not directly comparable. But we were tasked by the advertising market in the UK to try and understand, well, have the advertising rules fundamentally changed since 2017? Has this move to performance media impacted the ROI that advertising to the established media changed? And do established media channels such as TV in all its forms still financially deliver for advertisers? So that was quite a task. So what we did, because we'd found the formula of profitability 1 quite good, we repeated it. It worked last time, but we went bigger. We got more advertising agencies, more clients, more brands involved. So what profitability 2 is, we worked with 5 modeling agencies, which were Ubiquity, Essence Mediacom, Gain Theory, Mindshare, and Wavemaker, and pooled a lot of the econometric modeling that they had already done for their advertisers. Right, I stress, this is not a TV company going out and asking people to conduct a whole series of econometric modeling or market mix modeling that, by definition, would, of course, favor TV. These were models that had already been done to individual clients' briefs and needs. What we did is we harmonized them in order that we could look at the norms across all of those brands. In this case, 141 brands spending in total about 1.8 billion pounds, which is getting on for 4 billion Australian dollars. We got data on 14 sectors and large enough sample size on 7 sectors to provide granularity on what's happening in terms of advertising profitable return. We looked at 10 media channels, and really interesting, we found of that 141 brands, 53, so profitability 2, we did purely post-COVID. So this was trying to get clear of COVID. So all of the brands and all the modeling that we looked at was from 21, 22, and over 50% of it was from 2023 campaigns. We found 53 brands that were pre-COVID and post-COVID in terms of identical. They were using the same media agency, the same modeling agency, and therefore we can compare directly what changes had occurred pre and post-COVID. Bucket loads of stuff we found. I think there's 6 quick highlights that I'm going to run through today to give you a flavor of. Lots more information available if you need it. So, number 1, we proved that there was a definitive, still concrete case, a new concrete case for advertising. In fact, we identified that the average short-term ROI, so this is short-term profit ROI, across all of the categories and all of the brands was £1.87. So basically that means for every £1 invested or $1 invested or €1 invested, you were getting £1.87 back in the short term being up to 13 weeks. If you extend things out to the longer term, because obviously advertising delivers over a longer period, the longer term, the full term, in this case, it takes up to 2 years, advertising was paying back a profit ROI of £4.11. So we proved that despite all these changes that people perceived had occurred as a result of the COVID and the COVID situation and all the changes, that advertising was still a profitable occurrence for brands. Advertising delivers for brands. Deep sigh, most of our jobs are therefore no longer at risk. But people want the granularity. The devil is in the detail. So the performance, of course, delivers greatly from channel to channel. Quick educational chart, you're going to get some bubble chart. Okay, this chart, along the x-axis, we've got spend. So this is the percent of the total investment that will be going into each individual channel. Up the y-axis is, in this case, the short-term profit ROI percent. I mentioned that this is a £1 break-even, so putting it in very simple terms, anything above 1 means that the advertising is delivering a profitable return. Anything below isn't. Chucked in here, this is an example of TV. So this is what we found on average across all categories. TV delivered around about, in the short term, 35% of the spend was spent on television, and its short-term profit ROI was around about just under £2. The size of the bubble is a kind of volume. The bigger the total percentage of the volume, in this case, TV delivers about 33–34% of the total profit, short-term profit, that have been delivered by advertising across all of these brands. So where do all the various channels fit in? So this is what the UK marketplace is looking like in terms of profitability. A couple of interesting points I'd point out. Somewhere directly above me, print. Okay, pretty old-fashioned. This is the print on paper. The digital part of the news brands is in another bucket. Print, it turns out, is still highly profitable. Now, why is this? Well, basically, there's been a significant de-investment by a lot of brands, but those who are still remaining using print have found out how to use it and how to work it very effectively. It tends to be in certain categories, say retail. It tends to be in certain categories where there's a lot of data. So automotive, there's lots of data about that. There's lots of specialist magazines. Print, if you do it well and know how to do it, can be highly, highly profitable. TV, in this case, linear TV is split from BVOD. linear TV takes the greatest share, and then just below that, we've got generic PPC and paid social. Okay, so we launched Profitability 2 midway through last year, and we've had lots of excitement. Starting with the Scandinavians decided, we like that, but our country is different. What we're going to do is we're going to replicate the work. So the Scandinavians have got a 2-hour presentation explaining exactly why their market is different from the UK, and then they put up that chart, because that's what their figures are. So TV, it's about 35% in the UK, and it's an average of about 1.8. Okay, no, that's Scandinavia as well, sorted. So basically, different market, but Scandinavia appears to be pretty similar to what we're finding in the UK in the short term. Obviously, we can look at this also in the long term. So the profit ROI in the long term, so this is up to 2 years, it grows. Certain channels become much stronger because they have a much longer impact. TV being the primary one. TV delivers over time. Its decay rate is much, much slower, which means it keeps on delivering right the way up to the 2 years. Now, there's lots of bubbles and information I've chucked at you here. The easiest way to think about how a channel is performing is to do a chart like this. The line in the middle is equality. So basically, it's saying if you're spending 25% of share, you should be getting 25% of return. So channels that are above the line are punching above their weight. They are delivering more profit than they are getting investment. That will be television. Channels below the line are having more money spent on them than the pure profit that they are delivering suggests they should. In this case, generic PPC, and if you run the numbers, specifically paid social is being overinvested. Okay. At this point, and I hope I know my audience, there's a bunch of cynical people out there going, yeah, but Australia is, of course, different. Okay? So, at my great personal expense, I'm about to show you a chart that you're going to boo me for. Basically, I've been persuading the Group M and Choreograph team in Australia to replicate this analysis. I'm going to show you some data. I stress, this is interim results. It's not the final results. The final results might change, but for you, today, this is what it looks like in Australia. Okay, so what would I point out? Firstly, you really don't use print here, do you? Secondly, you're obviously doing econometric modeling, because basically what happens, if you're doing lots of econometric modeling and then applying it, you regress to the mean. In other words, you follow what you find in the modeling, which means you get closer and closer to the line. So you're pretty close in terms of what the modeling is saying in terms of investment. TV, as we well know, is up there. What a surprise. It's always up there. The one that jumps out at me, and this is a really dangerous thing for me to say, because I'm afraid I don't know your market too well. Out of home isn't performing. In that case, it seems to be suggesting there's more money going into out of home in this market than the profitability is suggesting it should. I have no idea why that would be the case. I have no idea whether that will be the case when the final results come in. But I watch with interest, and I'm sure the Group M and Choreography team will be talking to you about that at some point fairly soon. Performance varies not only by channel, but by sector. Figures in the yellow at the far end are the ones I've just spoken about overall. But of course you go, yeah, but my market's different. We have information here which shows the profitability figures by category. And it's not, for those of you who work in FMCG, and I know quite a few of them here, it won't really come as a surprise to you that a pure return in the short term is really quite difficult. And therefore, the investment in advertising tends to have to be over the longer term. And financial services is also struggling to return much in the short term. What about this shift pre and post COVID? Because the commentators will have you believe that the advertising world has changed dramatically since before COVID. I'm here to tell you there's not been much change. Boring as that sounds, basically we're finding that advertising is as effective as it has always been. It's been a small, about 1% drop in the ROI since sort of 2017, 2018, but that's also come with a reduction in spend. In terms of AV, there's definitely been a shift. Most of the channels, to be honest, there's little change in terms of the ROI that they're delivering. In AV, what we have seen is the money's been following the eyeballs. As eyeballs have moved away from linear into video on demand and BVOD, the money has followed that, and the profitability has followed that as well. So over the last few years, BVOD specifically and online video have got more profitable. Two things that we've really identified. Pre-COVID, we as an industry in the UK had gone absolutely mad. We were putting more money than we really should do into online display, and it wasn't paying back. We've learned from that, and we've moved it back, and so online display is now proving a lot more profitable than it was in the past at a much lower spend. Unfortunately, paid social's gone the other way. More and more and more money has gone into paid social, and the only thing that's happened is it's got less profitable. That's the double negative whammy, double jeopardy, the wrong way round. More money into paid social, and you're getting less return for that. The other thing we need to look at is looking beyond digital is important for just for rapid payback. For the first time ever, we've been able to look at 3 different time periods in this analysis. So what's the payback in the week of the advertising? What's the payback over the first 13 weeks, traditionally called the short term? And what's the payback over the full term, which is the full 2 years? So this is the first time we've been able to identify by category, by media channel, the payback in terms of profit that advertising has delivered in the week of the advertising. And this has thrown up some really quite interesting things. So this is where the profit has been delivered in the week of advertising. Okay? Won't come as a shock to you that generic PPC, the bottom of the funnel, harvesting those sales, PPC performs very well, the best. But it's actually traditional channels that you might not thought as performance, like linear TV, that comes in second. And we were sort of thinking, why would this be? And I think as an industry, we've got ourselves, and there's a hint of this in one of the earlier presentations, we've got ourselves into a perception that established channels, so things like television, broadcast channels, are only for brand, and digital is what you want for performance. If you want performance, it has to be digital. And what this data has shown us very clearly is that every channel can do both. It's how you use it and how you use it in combination. And this is specifically how you use the creative work as much as the media work. So TV can be a performance media as well as a brand driving media. We've now got the evidence to prove that. And so finally, the short-termism is costing brands money. So what we were seeing here is across the complete data set, 24% of the total profit is returned in the week of advertising, about 42% across the first 13 weeks, but is nearly 60% of the profit that advertising delivered is beyond the first 13 weeks. And if you've got the ability to harvest and build over time the profit, the channels that can deliver that, like TV, become more and more powerful over time. And so how that builds up, so these are the channels in terms of how they perform in the week of the advertising. That's how it builds after 13 weeks, and that's what it looks like in terms of percentages across the full period. So ultimately, TV as a whole is delivering 55% of revenue for 45% of the investment in the UK. As I said, I promised you a couple of QR codes. All of that information in excruciating detail is available via that QR code. You can download the book, 133 pages. That's on the Thinkbox website. There's presentations, there's information. And if you want to get your hands on the data, there's a tool called the Media Mix Navigator, which is not unlike the media engine that you have in Australia. All of the data is in there, and it allows you to play scenarios that are reflective to your brand situation, your investment, and it gives you an indication of where the most profitable media budget allocation lands, depending on whether you want to invest money, generate your return in the short, the medium, or the long term. Thank you very much.